Hello, I'm Megan Horniman, the Chief Investment Officer for Verdant's Capital Advisors. We're coming to you today to give you an overview of our most recent white paper where we discuss the health of the Chinese economy. The state of the Chinese economy has been scrutinized lately, primarily because of a very lackluster second quarter GDP report, as well as a month-over-month decline in inflation. Both of these are extremely rare occurrences for China. We're seeing economists downgrade growth potential for China in both this year and next year to 5% or even lower. And in this white paper, we're not going to focus on all the complexities of the Chinese government. Instead, we're going to discuss how China has risen to be a global superpower, discuss some of the structural challenges that we see, as well as do we think this is an investing opportunity right now in China. China's economy has been transforming for many, many decades. In the 1980s, it started with trying to bring the lower and middle class up, as well as bring in investment into China through foreign direct investments. Tax incentives brought businesses there as China became a production hub. And by 2009, as you can see in this chart, China overtook the US and Germany as the leading global export. The next step was really to bring the economy from an agricultural economy to a more service, urban-oriented economy. This promoted a property bubble. We saw that there were tax incentives. The Chinese government went from state-owned real estate to private-owned real estate. Property developers were buying up land left and right, and it started the big commercial and residential property boom we've seen in China. We go into greater length about the many structural challenges that the Chinese economy faces in the full white paper. However, we're just going to focus on a couple in this video. First of all, the property bubble is bursting. Many years of overbuilding in China, combined with the fact that of COVID, the global economy slowing, the Chinese domestic economy slowing, all of this is creating many problems in the housing market there, not just commercial, but also residential. We're seeing bankruptcies pile up from the property developers, and now we're seeing the shadow banking system exposed. And the shadow banking system is where people and property developers turned to non-traditional banks in order for lending, especially when those banks began tightening lending standards. The second thing is the consumer is really starting to slow down. The consumer was supposed to help cushion that blow from the property bubble bursting. But unfortunately, after a pretty big rebound when the Chinese economy reopened earlier this year from COVID lockdowns, consumers have weakened significantly. Part of the issue is that they were heavily invested in real estate, and we just discussed the property bubble bursting. The third thing is China is no longer an export behemoth. What we have seen after COVID is companies have decided to diversify their production around the world. We've also seen that the global economy is slowing. All of these things are contributing to a pretty sharp decline in foreign direct investment, as you can see in this chart. You've seen it falling now at a rapid pace on a year-over-year basis. The last thing that we're going to mention is demographics. In 2022, the Chinese economy declined for the first time since the 1960s. This is troublesome for the economy from a structural standpoint because their older population requires the younger population, and right now we're seeing those demographics shift and a significant aging of their population. This is a trouble for the Chinese economy. Chinese equities, when you look at the MSCI China Index, is underperforming the MSCI All Country World Index by over 1,900 basis points this year alone. As a result, valuations are very attractive, so it's easy to look at this as an opportunity to invest. However, we're not ready to get overly optimistic about China. Now, in a well-diversified portfolio, it's nearly impossible to not have some exposure to Chinese equities because Chinese equities make up the majority of the MSCI Emerging Market Index. But we're not ready to add to that exposure. We're neutral to underweight this area, and we don't have any significant amount of targeted exposure to Chinese equities. There's a couple reasons why. First of all, the political and geopolitical uncertainty is just too much right now for us to be aggressive with China. Second of all, the stimulus we've seen has not been very well received by the economy. And lastly, we haven't seen any government measures that would be a catalyst to really reignite the the consumer in China, and that's very important to the future growth in China. China has a rough road ahead. There's many structural challenges that need to be addressed. The years of overbuilding and leverage, that bill is finally coming due. Not only do they have a debt problem at the property level, but they also have it at the local government level. This is a leverage issue that needs to be addressed by the Chinese government. Also, when it comes to China, with the rising geopolitical tensions we've seen in the past couple years, there's a trust issue with global investors, as well as that lack of transparency from the Chinese government. Now, from a global economic perspective, it's very difficult to say that any economy can escape a weakness in the Chinese economy. It is still a global superpower. We do think some of the bigger export-driven countries will suffer from a slowdown in the Chinese consumer, so we'll continue to monitor that from the global economic perspective. If you have any questions at all, please feel free to reach out to any of your financial advisors. I'd also like to invite you to tune into our most recent Markets with Megan podcast that we release on a weekly basis.